Everyone dreams of getting rich fast. And in the world of investing, day trading looks like the shortcut. The flashy screens, the charts, the quick profits. It all feels like a modern-day gold rush. But here's the truth no one talks about. For every trader showing off their winning trades online, there are hundreds quietly losing money behind the scenes. On the flip side, long-term investors, the ones who buy and hold quality assets, rarely make headlines, but they quietly build serious wealth over time. So what's the real difference? Which strategy actually pays off? Let's strip away the hype and look at the facts. Day trading is all about speed, timing, and precision. You're buying and selling stocks, sometimes within minutes, to profit from short-term price moves. It's exciting, but it's also stressful. You have to make split-second decisions, read charts, predict trends, and react instantly to news or volatility. A single mistake can erase weeks of gains. Long-term investing, on the other hand, is about patience and consistency. It's the art of letting time and compounding do the heavy lifting. You're not chasing quick profits. You're buying quality companies or funds and letting them grow over years, sometimes decades. It's less flashy, but statistically far more reliable. Here's the kicker. Studies show that over 90% of day traders lose money in the long run. Meanwhile, long-term investors, especially those in index funds, tend to outperform the majority of active traders simply by staying invested. In this breakdown, we'll explore both sides: how day trading really works, why it attracts so many people, the psychological traps that destroy traders, and the simple yet powerful reasons why long-term investing keeps winning. By the end, you'll know exactly which approach fits you and which one actually builds wealth that lasts. Day trading is the financial world's version of a high-speed chase. It's thrilling, fast, and filled with adrenaline. The idea is simple: buy low, sell high, sometimes in a matter of minutes or hours, and repeat until you've made a profit. Sounds easy, right? But in reality, it's one of the toughest games to win. What draws people in is the illusion of control. You're sitting at your computer, charts glowing, your finger hovering over the buy button. You feel like you're in charge. Every small win feels like validation that you've cracked the code. But the market has a way of humbling even the smartest traders. One sudden news headline, one algorithmic move, or one emotional decision can turn a great morning into a disaster by the afternoon. Here's what most beginners don't realize. Day trading isn't gambling, but it's close. Successful traders spend years mastering technical analysis, risk management, and emotional discipline. They have strict stop losses, trade setups, and strategies they follow with military precision. Even then, they often win only slightly more than they lose, but the key is minimizing the size of losses. The problem? Most new traders don't have that kind of control. They chase momentum, revenge trade after a loss, or let emotions cloud judgment. Over time, trading fees, taxes, and emotional exhaustion eat into their profits. Then there's the time factor. Day trading is practically a full-time job. You need to constantly monitor charts, watch the news, and react instantly. Miss one moment and you could miss your chance. Or worse, take a big loss. The few who do succeed are usually professionals with years of experience, deep capital, and top-tier software tools. For everyone else, it's an expensive education. But if day trading sounds so brutal, why do people keep trying it? Because the promise of quick money and financial freedom is just too tempting. Still, for those seeking consistent wealth instead of short-term thrills, there's another path: the long game of long-term investing. And that's where things start to get interesting. Long-term investing is the complete opposite of day trading. There's no flashing screen, no minute-by-minute stress, no heart-pounding trades. It's slow, strategic, and rooted in patience, but that's exactly why it works. The idea is simple: you buy quality assets, like stocks, index funds, or ETFs, and hold them for years or even decades. Instead of trying to time the market, you let compound growth do the heavy lifting. Albert Einstein called compounding the eighth wonder of the world for a reason. It quietly multiplies your wealth while you sleep. Here's what makes long-term investing so powerful. Time smooths out volatility. The market may swing wildly in the short term, but over the long run, it trends upward. For example, the S&P 500 has averaged around 10% annual returns historically, even with recessions, crashes, and wars in between. That means your money can double roughly every 7 years without needing to check your portfolio every day. The best part? Long-term investors don't have to predict the future, they just need to stay consistent. Contribute regularly, reinvest dividends, and avoid emotional decisions. When others panic and sell during downturns, long-term investors buy more at a discount. That's how wealth is built. Not by jumping in and out, but by staying in while others lose faith. And unlike day trading, this strategy doesn't demand constant attention. You can have a career, a family, a life, and still grow your wealth. The key is discipline. Avoid market noise, ignore short-term headlines, and focus on the big picture. But let's be honest, patience is hard. Watching the market rise and fall without reacting takes emotional strength. Yet those who master it often end up miles ahead of the traders chasing daily profits. Now that we've seen both sides, the thrill of day trading and the patience of long-term investing, let's break down how each approach impacts your risk, time, and emotional balance in real life. When it comes to investing, success isn't just about knowledge, it's about managing risk, time, and emotion. And this is where the gap between day trading and long-term investing becomes crystal clear. Let's start with risk. Day trading is high risk by nature. You're making dozens of decisions a day, often with leverage, meaning you can lose more than you invested. Studies show that over 90% of day traders lose money in the long run. It's not because they're dumb, it's because the odds are stacked against them. Markets move unpredictably, fees add up, and emotions cloud judgment. One bad trade can wipe out weeks or even months of progress. Long-term investing, on the other hand, spreads risk across time. Even when the market crashes, it eventually recovers. Historically, every downturn, whether it was 2008 or 2020, was followed by new highs. That's why seasoned investors say, time in the market beats timing the market. It's not about catching every perfect entry, it's about staying in long enough for the market to reward you. Then there's time. Day trading requires your full attention. You're glued to the screen, analyzing charts, reacting to news, chasing momentum. It's practically a full-time job. Long-term investing? It's the opposite. You can automate contributions, rebalance once or twice a year, and let compounding handle the rest. Your time becomes an ally, not an enemy. And finally, emotions. Day traders ride an emotional roller coaster: fear, greed, excitement, panic, all in one day. Long-term investors, by contrast, learn emotional discipline. They play the long game, not the short-term reaction. So while day trading tests your nerves, long-term investing tests your patience. Both are challenges, but only one rewards consistency over chaos. Next, let's talk about the financial results. Which one actually pays off more in the long run? Let's be real, everyone wants to know the same thing. Which one makes more money? Day trading or long-term investing? The truth is simple, but not easy to accept. Over the long run, long-term investing wins almost every time. Here's why. Day trading might give you fast wins, but those wins are usually short-lived. For every trader who doubles their account, there are hundreds who blow theirs up trying. Research from the University of California found that only about 1% of active traders consistently beat the market. And even they often underperform once taxes and fees are factored in. Long-term investors, however, don't need perfect timing, they just need consistency. The S&P 500 has returned roughly 10% annually over the past century. That means if you simply bought and held an index fund, reinvested your dividends, and didn't panic sell during downturns, your wealth would have doubled roughly every 7 years thanks to compound growth. That's not luck, that's math. The biggest difference? Day trading builds stress, long-term investing builds freedom. Day traders live on adrenaline, constantly chasing their next win. Long-term investors sleep peacefully knowing their money is working even while they're not. One path trades time for tension, the other trades patience for prosperity. So if your goal is sustainable wealth, not daily drama, the answer is clear. Invest long-term. Focus on owning quality assets, automate your contributions, and give compounding time to do its magic. Because here's the truth, you don't need to beat the market, you just need to be in it. Start now, stay consistent, and let time make you wealthy. If you found this breakdown helpful, hit like, share it with a friend, and follow for more no-fluff financial insights that actually help you win the money game. Alright, here's the takeaway. Day trading is flashy, but long-term investing builds real wealth. The market isn't a casino, it's a growth engine that rewards patience, consistency, and smart choices. If you're ready to take action, here's a simple roadmap. Pick a core investment strategy. Choose low-cost index funds or ETFs that match your risk tolerance. These are your foundation. Automate contributions. Set up monthly deposits so you invest without thinking. This ensures consistency and removes emotional decision-making. Ignore the noise. Markets will fluctuate, news cycles will scare you, but your focus should stay on your long-term plan. Reinvest dividends. Let every dollar work harder by compounding over time. Track progress annually. Adjust allocations if needed, but avoid constant overtrading. Remember, the biggest advantage long-term investors have is time. Compounding doesn't just grow money, it grows freedom, opportunity, and security. So don't chase short-term wins. Build a system, stick to it, and let your wealth grow quietly but powerfully. The money you invest today is planting seeds for decades of financial freedom. If this guide helped you understand the difference between day trading and long-term investing, hit that like button, subscribe for more actionable financial tips, and drop a comment below. Are you team day trading or team long-term investing? Your financial future starts with the choices you make today, so make them wisely.